Okay, Rudy here. I started this channel a year ago to help people create wealth on the back of watching a few YouTube videos on people promoting popular ETFs for growth, which I didn't agree with, and uh, hence started the channel. But this video isn't all about that, so I'm trying to cast my net a bit wider to those people who think investing in conservative options or largely bond, safe bond options is not the case right now. Okay, so I'm not focused on the share market. That's a whole. Join the channel if you want to know more about that. So we're looking at Australian super. Now they're all the same. All the super funds are the same, basically. Maybe 0.5% per annum each way, blah blah. Um, so we're focusing today on the stable and the conservative balanced, and we'll have a look at what that actually means. But so we can see over 5 years, 4% for stable. Last year was 7%, and financial year to date 2%. So that all like going, oh yeah, that's just pretty calm, pretty, nothing to worry about there, is there? Okay, so so if we go and look at the asset allocation, okay, so this is the stable fund, so it's 20 and 17, so about 30% in shares, and then they've got there's your windmills and solar panels infrastructure, which you can't value. But anyway, it's predominantly fixed interest. Okay, it's predominantly a fixed interest credit, fixed interest, and then conservative balanced, which isn't really the focus, but if you are in this thinking, conservative, it gives that feeling. Well, you are basically 50% in shares, and so it's basically 50% shares, 50% bonds, and 15% windmills and solar panels. Okay, so get to the point, Rudy. All right, now because they don't publish like daily unit pricing or whatever, what I use is proxies. So this VDCO is an ETF, Vanguard Diversified, and it's basically 70% bonds, 30% shares. Okay, so it represents your conservative super option. So just to validate that, it is a proxy, if we look at, so this is from 1 July 20, so we start from there, and we go to the, so you can see down the bottom, so 1st of July, so 20, let's call it 20%. Okay, so 20% over 5 years, so 4%. Yeah, okay, so what about the 7? Okay, so if we look at, because it's, so from July, because it's the financial year, they're doing it off to move down the bottom. So 7%. Okay. All right, so that looks all pretty good, but and it's been very nice, but back here it lost 13%, and there's a good chance that because you can see we're approaching one of those moments here. Okay, so why would it go down, Rudy? Why? Okay, so there's this, bonds are valued basically by interest rates. So this is Australian 1 year interest rates. Okay, so where they're going up Australian 5-year interest rates, they're going up. But that's good for bonds, isn't it, Rudy? High interest rates. Well, not really. So what we're looking at here is a bond, VAF. So this is a typical bond fund. And you can see if we go and overlay interest rates. Okay, so the blue line here are the interest rates. So you can see when interest rates go down, bond prices go up. When interest rates go up, bond prices go down. Okay, and so you can see they went up, they went down, and they've been going sideways, but bond prices have been going up. And as you saw before, interest rates are now peaking. So we're like going into one of these phases here. Interest rates rising, bond prices down. And you can see it gets accelerated because, so this pricing here includes the actual, so it's the price of the bond movement plus the interest payments. If we go and remove the interest payments, so it's basically just the bond prices, you can see it's a lot clearer. Okay, so this is the value of the bond. So you can see here, it's a lot more clearer. Interest rates down, bond price up, interest rates up, bond price down. You can see here we've sort of gone sideways, and now we're breaking out. So this bond price is going to collapse. Okay, so that's because that chart there was without the interest payments. Okay, so because you've got to look at the sum total, of course. Okay, so that's Australia. So now we're looking at American. So these are 1 year American bond rates, interest rates, 1 year interest rates. You can see we're breaking out here. US 5-year rates. Again, we back here in April 21 when that was the COVID lows. We all know about that. And interest rates are now, these are setting up to go break long term. So again, we use a proxy because your super fund has basically got Australian and international bonds in it. All right, we'll just check what you're saying there, Rudy. Oh, they haven't got it in this one. Anyway, you can check it yourself. But basically, this fixed interest here is made up of Australian and international shares. So these are your international bonds. This ETF, VBND, it's a proxy. So the same thing, we can look at, so we'll look at US 5-year interest rates. And we'll just take away the interest payments for now. Okay, so you can see here interest rates up, bond prices down. Okay, and now we're in this, well, sideways. So now we're breaking up again. So interest rates down. And even if we add back the interest payments, okay, so we'll just remove that to make it a bit clearer. So this is including your interest repayments, and you can see this is forming a what we call a rising wedge, which is bearish when broken. Okay, so a bit like here, again with those interest rates increasing. Okay, so bonds are not safe, and it's the opposite. So So what's the point, Rudy? So basically, if I think a lot of people think bonds are like a bank account, um, and it gets promoted like that. It's like this, like, oh yeah, I get 4%, 5% per annum. That's pretty cool, but it's not. So I guess my point is just well, first was just to highlight if you didn't know, because I'm pretty sure a lot of people don't know, um, and just put it in a bank account. Just put it in cash, because you're going to get 5% in cash. So why would you risk? Cash is going to perform just as good as this. You're going to get 5%, and I've just shown you that when interest rates go up, bond prices go down. So why wouldn't you just stick your money in the interest rates are just going to be going up over the next few years. So just take your 5 and maybe 6 and maybe 7, maybe 8. Just stick it in the bank. Yeah. And as for the share market, well, it's a whole different story. That's, if you don't know, it's down at the moment. It's going to be volatile. Not over, short term is pretty risky. So, but yeah, that's not the point of this video. If you're interested in the share market, then join the channel. $10 a month. We go through. Don't really focus on this, but I am putting a focus on dividend paying stocks that will pay more than the bank rate, but won't go down with interest rates. Yeah. Anyway, all right. I hope that taught you something. Give us your feedback. All right. See ya.